Hi, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services, and in this presentation, we'll be talking about why you should borrow against your investment portfolio instead of getting a mortgage, right? And if I was to simplify this entire presentation into one simple question, it's why borrow from a bank at 5 to 6% when you can borrow from your investment broker at 2% to 3%? So that's the quick little pitch for the entire presentation that we'll be kind of talking about, and how you can borrow against your investment portfolio. Again, if you want a mortgage or just for the down payment, or if you're instead of refinancing your house, or just for some extra liquidity while allowing your investments to continue growing, right, without paying taxes. So that's a quick summary of what we'll be talking about in this presentation. So let's go over a couple of quick points we'll be talking about here. The first is we'll just talk about the highlights of using margin/portfolio borrowing at low rates and why that's a huge benefit. We'll then talk about how does mortgage home borrowing work. And the reason we're going to talk about this is because this is an easier concept for people to grasp, is that when they purchase a home, they're essentially borrowing, putting 20% down and borrowing against the value of the home. So once you understand this concept, you'll understand that you can do the same thing with your investment portfolio, and how you can use that to borrow at significantly lower rates than you can when you borrow against your home value, and how you can utilize that to both, improve returns as well as protect some of your downside. We'll then talk about what are the pros and cons of using margin borrowing over traditional mortgage home borrowing. And then finally, just to talk about how you can get help in utilizing margin/portfolio borrowing and what we can do to assist you. Let's just do a quick introduction to myself and my firms. My name again is Rajiv Rebello. I'm the Chief Actuary of both Colva Actuarial Services and Colva Capital. Colva Actuarial is an actuarial and insurance servicing company that works with high net worth clients and registered investment advisors, basically to help them utilize better after-tax, after-advisory fee solutions for their clients. Colva Capital is a RIA that focuses on alternative assets and helps investment groups invest in uncorrelated alternative assets, as well as working with ultra-high net worth individuals who are looking for tax-efficient investment solutions through private placement life insurance. So now let's jump right in. Well, what is margin/portfolio borrowing? So margin is just borrowing against your portfolio. So some people are familiar with the term margin. Other people, it's easier to understand portfolio borrowing. So margin borrowing is borrowing against the value of your investment portfolio. And again, it's similar to borrowing against your home value for mortgage or refinancing. So what are the benefits of borrowing against your investment portfolio? Well, the first is that you can borrow at low rates and essentially earn a spread. So the long-term, stock market returns are about 10%. So if you can think about, there's an opportunity here if you're borrowing at 2% to 3% and you're earning, 8%, let's say, with only 20% down, right? So you're earning a spread. You can kind of compare that just from a borrowing capability against, mortgage rates right now, which are about 5% to 5.5%, right? So if you need liquidity, it's much better to borrow at these lower rates than at, 5 to 5.5%. Another huge benefit of margin borrowing is that it allows you to retire early by borrowing against your investment portfolio instead of taking taxable withdrawals, right? So if I'm borrowing against it at a low rate of 2% to 3%, instead of paying 20% to 30% in taxes, right, that extends the lifetime of my portfolio. So I actually go into this in great detail in another presentation. I'll try to put a link here in the description as well as in this presentation. So you can go and watch that as well if you're interested in how you can use margin portfolio borrowing, essentially to lower your taxes in retirement, retire early, as well as pass on more wealth to your beneficiaries through step-up in basis. So that's a really cool presentation I'll link to, but we won't be discussing in this presentation. It is a huge benefit, though, of margin borrowing. Again, in that presentation, we also talk about how you can invest for the long term and have beneficiaries inherit the majority of the gains tax-free. And again, while allowing the retiree to borrow against it in retirement. So it's a really, really cool tool for minimizing the taxes you pay, passing on, and creating generational wealth. Again, these two topics we won't be talking about in this presentation. I'll provide a link for that because it's more detailed. But you can understand the value add, right, of simply just borrowing at low rates and earning a higher rate on your assets without paying taxes on it. Huge benefit. So let's kind of, just to understand again how portfolio margin borrowing works, let's just focus on mortgage home borrowing now for a second, and then we'll jump back into margin borrowing. We're going to use a hypothetical example of applying for a mortgage and see, once we understand the details of that, we'll jump right into portfolio borrowing. So it'll make it easier to understand. So let's say we have a client. A client wants to buy $1 million home. The bank is willing to lend this client $800,000 at 5% for 30 years. The client, however, must put down 20% of the home, or $200,000, right? And make a monthly mortgage payment. So that mortgage payment is slowly paying down the value of the loan. So right now at inception, when the client applies for the mortgage, that's an 80% loan to value because they're borrowing $800,000 against $1 million home. Let's just talk about the pros and cons real quick of mortgage borrowing. The first is the benefit of mortgage borrowing is that if the home value drops, the bank won't foreclose on the home, right? The only time they'll foreclose on the home is if you miss the mortgage payment. So as we'll see later on in this presentation, even if the value of the home drops and the loan to value becomes higher than 80%, the bank isn't going to foreclose on any part of your home. The other downside is that on the current tax laws, the mortgage interest the benefit is that the mortgage interest is tax deductible, but only up to $750,000. So now let's kind of jump into the downside of mortgage borrowing. The first is that you're essentially only borrowing against one asset. So you're investing a heavy amount into one asset, which is your home, and you're borrowing against that. So it's not really diversified, right? So if your home value takes a sudden hit, you're going to lose equity, the value, your down payment, at least temporarily, if the home values don't increase. So investing in one asset or borrowing against one asset is never the greatest of ideas. But that's one of the downsides to mortgage borrowing, again, in comparison to portfolio borrowing. Again, another downside is that you have to make monthly mortgage payments and make sufficient income, right? You're not going to qualify for a mortgage if you don't make sufficient income, or if you're you run a business, you're self-employed, your income's variable, it can get more difficult to take a loan. And what's interesting is that even if you have a huge investment portfolio, if you're not making income, they might not give you the loan, which is super interesting. Again, the downside is if you miss the mortgage payment, the bank can foreclose on the home, right? Usually you have to miss quite a lot before they initiate those steps, but that is a downside, right? Another downside is that lending rates are expensive relative to margin rates. So we're talking about 5 to 6% versus 2% to 3%. And again, the tax deduction is limited to $750,000. So that's, those are the quick benefits and cons to mortgage borrowing. Now let's talk about how does margin or portfolio borrowing work. So we're going to use our same client example. The client wants to buy $1 million worth of investments instead of $1 million home. The investment broker is willing to lend the client $800,000 at 2.5%. The client must put down 20%. So just like in the home, you're putting down 20%, so $200,000. So again, this is an 80% loan to value ratio because the loan is $800,000. The asset is worth $1 million. We'll see how this is more important, this LTV ratio in margin borrowing than it is in mortgage borrowing in a second here. But first, let's talk about the benefits of margin borrowing, right? So the first is that you're borrowing against a diversified portfolio of investments, right? So you're not just borrowing against one home or one asset, you're borrowing against a diversified portfolio of investments. The next is that your borrowing rates are significantly lower than mortgage rates. So if you're looking right now, the borrowing rates are 2 to 3% versus 5 to 6% for a mortgage right now. Another huge advantage is that there's no monthly mortgage payment requirement. So you're not required to pay off the interest or pay off the mortgage each month, or towards the principal rather. However, you can if you want to. If you want to pay the mortgage interest or the margin interest, it can be valuable as a tax deduction. We'll see in a second. But there's no requirement for you to pay anything back. So there's no income requirement. So no one's going to be looking at how much you make, or if you have a business that has a variable income. So as long as you have the assets there, that's all that really matters. You don't need to pay anything back. You just, again, as we'll see in a second, you just need to maintain this 80% LTV ratio. There's no income requirement. So these are a couple key advantages for borrowing against your portfolio. Another huge advantage is that margin interest deduction limit can be significantly higher than $750,000, right? So if you're deducting mortgage interest on your taxes, currently there's a limit on this. However, for borrowing against your portfolio and paying off the interest, there's a much higher deduction than $750,000. So that is essentially capped by amount of investment income you're making. So if you have a large portfolio, then you can deduct a lot more than the $750,000 or up to this limit of $750,000 in debt. So now let's talk about the downside to margin borrowing, right? So the huge downside is that if the value of investments drop, the broker can sell some assets to keep the loan to value at 80%. So the key thing here is that the loan to value has to be 80% or less, right? So whereas if your home, again, value drops, as long as you pay the mortgage, you don't have to worry about that at all. So this is the key differentiator, is that you have to keep the loan to value at 80%. And as we'll talk about, you can do that by dumping in more cash, right? So that'll lower the loan to value ratio because you put in cash, essentially paying off some of the loan, or you're forced to sell some of your assets. Another downside here is that the safe down payment ratios are higher than mortgage borrowing, right? So whereas mortgage borrowing, you only have to put in 20%. It's safer to put in 30% to 40% of the value of the asset, simply because you don't have to worry about the loan to value ever dropping below 80%, right? So you're putting in more equity, because if I put in 30%, then the loan to value ratio is 70%. If I put in 40%, the LTV ratio is 60%. So I don't have to worry as much about hitting this 80% limit. So safe down payment ratios are higher. That's one downside. You want to either do a couple of things. You put in more equity or just monitor it closely. So you can put it in 80% or close to it, but you just have to monitor it that much more closely, right? The last downside is that interest rates are variable. So as interest rates go up, you'll see that the margin borrowing rate will go up. However, in spite of it going up, these interest rates will not be as high as a current mortgage rate will be. So there's always going to be a spread there between, due to the fact that the rates on borrowing against your portfolio will always be lower than the rates on borrowing against or your home value. So now let's just look at some quick math. Let's not get bogged down by the math, but I just want to show you the value of using leverage properly, of using a low cost leverage in terms of an investment approach. Now, I realize that most people don't treat their home as an investment, but you really should be looking at the appreciation value and the kind of mathematical components of your investments, especially since you're putting a large amount of your own equity and you're borrowing a large amount against one investment, which is your home, right? Let's again use our same client example. The client wants to buy $1 million home. The broker is willing to lend the bank in this case is willing to lend the client $800,000 at 5%. The client must put down 20% of the home value, or $200,000. Right? We're going to make a simple assumption that the home appreciates at 5% a year. So what is the IRR? What is the return, right, on my $200,000 that I put in, or the client puts in? What's the IRR after 1 year? So let's just do some quick math. This should be simple. I don't want you to get lost in the minutia, but it's important to just understand the value of using low-cost leverage, which we'll see in a second here. So $1 million home appreciates at 5%. That's $1.05 million. The $800,000 debt, increases at 5%. Again, we took a loan, right, at 5%. So that goes from $800,000 to, that's $40,000 of interest in just the first year, right, to $840,000. What's the equity? How much does the client now have equity in this asset, right? The asset is the home, and the equity is just the difference between the value of the home and the debt. So the equity is $1.05 million, like we talked about here. The debt is $840,000. So the difference here is $210,000. So now let's talk about the gain, right? What's the gain? So the equity is $210,000, but the client put in $200,000 at the beginning. So the net gain here is just $10,000. The $210,000 of current equity minus the $200,000 starting equity. So there's $10,000 gain. So if the client's looking at their investment return on this investment, it's $10,000 over $200,000, which is about 5%. And the loan to value, again, is not as important here when taking a mortgage, but it's still 80%, right? Because the home appreciated at 5% and the debt appreciated at 5%. So we're okay here. If the debt increased higher than the value of the loan, then the loan to value ratio would be higher. Now let's take a look at margin or portfolio borrowing and the IRRs involved here. So we're going to use the same client again. Client wants to buy $1 million worth of investments instead of a home. The broker is willing to lend the client $800,000 at 2.5%. client must put down 20% or 200K of the value. This should say investment value. The investments appreciate at 5% a year. So what's the IRR after 1 year? So again, $1 million investment appreciates at 5% to 1.05 million. The $800,000 debt increases at 2.5% to $820,000. So that's $20,000 less than the home borrowing example. We're going to go through our calculations again. The equity is 1.05 million minus the 820,000, which is $230,000. The net gain, though, is just taking the 230,000 equity minus the starting deposit, or 200,000. So that's a $30,000 gain. So that, from an IRR standpoint, what they earn in that first year is 30,000 over the 200,000 of equity that they originally put in, and that's 15%. The loan to value ratio is 820,000 over 1.05 million, and it's 78%. And you'll notice that it's less than 80% because the value of the home at 5% is increasing at a greater rate than the cost of the debt. So we can quickly see that the value of borrowing at a low cost, not only does it alleviate the burden of debt and have you accrue less debt, but it increases the value of your investment, right? So, and when borrowing a home, we saw in the first year that the debt increased from 800,000 to 840,000. We essentially cut the debt in half this first year, right? So, and then the IRR, the appreciation is a lot higher. So that's the essence of the value of borrowing at a low yield, right? You have less of a debt that you're accruing, and the value of your investment, your IRR, is higher. And the next thing I want to show is essentially, well, what's the IRR if we use more equity? We talked about how you might not want to use 20% equity, because then again, if the value of your investments drop, right, then you have to put in more equity or sell part of your investment. So we're going to look at using a different equity amount. We're going to look at 20, 40, 60, and 80%. So 20% obviously means you're putting 200,000. So that was this example right here. The loan amount is 800. That's the total $1 million for the investment. We saw that the IRR after 1 year is 15%. So if we do the same kind of calculation with 40%, 60, and 80%, here's what we have. 40%, you're putting in 400,000 and your IRR is 10.83%. Okay, still better than the 5% home example we use. 60%, you're putting in $600,000 of your own equity. You're only borrowing 400. So again, the IRR is 6.67. You put in 80%, $800,000. You're only borrowing 200. It's 5.63%. So even in these examples, when you're putting in high amounts of equity, right, your IRR is still better than borrowing it at 5%. So this is just some quick math to show you the value of borrowing at a low rate, especially at an asset class that's growing at a high rate, and the value of using low-cost leverage. So now that we talked about the upsides, right, of portfolio borrowing, let's kind of talk about the downsides of both. So we're going to look first at the downside of mortgage borrowing, and then we're going to look at the downside of portfolio borrowing. So here's our client. Again, the bank is, lends the client should say bank instead of broker. Bank is willing to lend the client $800,000 at 5%. Client must put down 20% or $200,000. But in this case, instead of the home appreciating, we're going to assume that the home depreciates at 10%. So the value of the home is going to go down. So what's the IRR after 1 year? So the $1 million home depreciates at 10% to $900,000. The $800K debt is still growing at 5% to $840,000. The equity is simply, the value of the home, which is now $900,000 minus the debt, which is $840. So it's 60. You have $60,000, or this client has $60,000 worth of equity. And the gain is simply the value of the equity now versus the value of the equity when it started. So 60K minus 200K, or a loss of $140,000. So they lost money here. The IRR is simply negative $140,000 over 200,000, which is negative 70% IRR. So you lost essentially 70% of your investment in 1 year simply by the home value going down by 10%. You might be saying, wait a minute, the home only went down 10%. How did I lose 70%? Is because you're the first loss position. When the value of the home goes down, the bank's not sharing with that first loss with you. You're taking the brunt of that loss. So you're taking your IRR is again negative 70%. You've lost $140,000 of your equity, and the loan to value ratio has now gone up. The reason why it's gone up is because the value of the home went down. So now instead of $840,000 divided by 1.05 million. Now I'm taking 840,000 divided by 900,000, and the loan to value is 93%. However, like we talked about, as long as you pay the client pays the mortgage, the bank won't require additional cash payments, right, to make the loan to value go down to 80%. So that's kind of the upside here, is that with borrowing against a home, is that even if the loan to value goes down, right, even if the loan to value goes up because the value of the home went down, you're not required to put in additional capital, right? So as long as you pay the mortgage, you're in good standing, even though you've lost this amount of equity. So now let's look at that same example, except with your investment value. Again, you have $1 million worth of investments. This again should say broker. The broker is willing to lend the client $800,000 at 2.5%. Same down payment. Client must put down 20% of the investment value. We're going to assume the investments depreciate at that same 10% a year. We're looking, what's the IRR after 1 year, right? So $1 million investment depreciates at 10% to 900,000, 800K debt increasing at 2.5% to $820,000. The equity is just the value of the investment, 900,000 minus the 820 debt, so it's $80,000. The net gain is just the value of the equity, 80,000 minus the starting equity of 200,000, which is a loss of $120,000. The IRR is just that negative 120,000 over 200,000, which is a negative 60% IRR. And the loan to value, right? It's 820,000 versus of debt over $900,000 investment value of 91%. So now there's an issue, right, with borrowing against your portfolio, because the loan to value is higher than the 80% you started with. So since the loan to value has increased above 80%, client must either deposit more capital or broker will sell some of their investments. So we're going to see both of these examples where the client deposits more capital versus the broker selling some of the investments. So now let's look at the example, that same downside example where the client's going to deposit more capital to get the loan to value back to 80%, right? So the client has $900,000 worth of investments and $820,000 of loan. So the client decides to deposit $100,000 of cash to the account to pay down the loan. So the loan decreases from $820,000 to $720,000. Now the loan to ratio is back to 80%. So it's $720,000 to over $900,000. So if the loan to value is increasing, right? So if you have a loss of value of your investments, depositing cash helps to decrease the loan to value. So that's one option. If the value of the investment starts decreasing, you're monitoring this, you can easily deposit cash into your account to lower the loan to value. So now let's look at the other example. The broker sells part of the investments. So let's say, again, the value of the home has gone down to $900,000, and you still have that $820,000 loan. So that's 91% loan to value. So let's say the client doesn't want to pay $100,000 in cash in to decrease the loan to value, or maybe they don't have the cash. They don't have $100,000 to put in. So in that case, the broker is going to sell $500,000 worth of investments and use that to pay off the loan. So now the investment value decreases from $900K to $400K. The reason being is that the broker sold $500,000 worth of the assets, right? They're then using that $500,000 to pay off the loan. So the loan decreases from $820,000 to $320,000. So now the loan to value is $320,000 of the debt over the $400,000 of the investment value, which is back at 80%. So if the client doesn't deposit more capital to keep this 80% loan to value ratio, right, the broker will sell investments. And the downside is this, if this happens, is that you're essentially selling the broker is essentially selling the value of the investments low, right? So the value of the investments drop, and they immediately selling the assets to keep this loan to value ratio accurate. So the problem with this is that you really generally don't want to sell low, right? Like when the value of the asset drop, you're selling it, right? So if it goes up, the next day or month or whatever, you're not getting that upside of the gain because they sold $500,000 worth of your assets, right? So that's a reason why you have to be careful of this when you're using margin. Is you generally don't want them to sell your assets, so you want to make sure that the loan to value ratio is really not increasing above this 80%. You don't want it to get to 91%. So you need to monitor it closely and ideally be able to deposit more capital. So either you're comfortable either depositing capital, or like we talked about, you're using higher amounts of equity. So instead of $200,000, you put in $300,000 or $400,000 to give you more of a buffer if you didn't want to deposit more capital later. So let's talk about some keys to margin borrowing. You only really want to borrow against safe, unvolatile assets. Preferably index funds, which are well diversified and safe kind of stocks, ideally, that won't see huge upswings or downswings, rather, in the value of the asset. Because again, if the value of the asset declines, then the loan to value ratio will increase. The next thing we talked about is borrow less than the maximum amount. So yes, you can borrow 80%, but then you have to monitor the loan to value ratio closely, right? And you have to be prepared to deposit more capital if the loan to value ratio starts to increase, right? So you have to monitor it closely. You have additional capital to invest. So for those who are more or less risk averse, you might want to go ahead and borrow the full 80%, right? Because that gives you the highest IRRs, as we showed earlier. But for those who are more risk averse and want to be more safe, you don't want to borrow the full 80%. If you don't want to deposit more capital, you can keep your borrowing ratios low at 30% to 50%. So you're borrowing a very limited amount. Your IRRs, of course, won't be as high, but again, you don't have to worry about constantly depositing more capital. And also keep in mind that if you're looking at a long-term horizon, over the long term, your investment value will grow. So if we look at stocks, even if we're in value stocks or safer stocks that are less volatile, even if it declines in 1 year, over the long term, equity will appreciate. The question is how long is that long term, right? So again, but if you take that long-term approach, you're essentially borrowing at a low rate, 2.5%, and your assets over the long term are increasing at 8%, right? So just a time horizon of you borrowing and waiting. So now let's do some quick comparisons between traditional mortgage borrowing versus margin borrowing. We're going to look at it kind of all on the same slide with that one example. A client wants to buy $1 million house, right? So they also have $1 million in investments making 5%, and they have $300,000 in savings account making 0%, because that's right now where the bank rates are about 0%. So let's look at traditional borrowing. So the client, is thinking, well, maybe I'll just, use traditional mortgage borrowing to buy this house, right? So the client needs $200,000 for the down payment. So they need to sell some of their investments, right? So in order to sell the investments, though, they're going to pay taxes on it, because there's about a 50% cost basis. So they have a $500,000, they have $1 million investments, but they started with $500,000. So if they sell the assets, they're going to pay taxes. So when you sell, you need to account for the taxes you're going to pay. So in order to get the $200,000, they really need to sell $285,000 of investments. So the client's going to borrow $800,000. So they're going to sell $285,000 worth of investments. They're going to pay 30% in taxes. That's going to give them the $200,000 for the down payment. So they need to sell $285,000 just to get the $200,000, right? So that's a huge ask. So the client borrows $800,000 at 5% traditional mortgage borrowing. That's an 80% LTV. So what's the client left with? The client is left with a $715,000 investment portfolio. Again, they sold the $285,000, making 5%. They still have the $300,000 savings, making 0%, and an $800K loan at 5%. Again, you'd say, well, why hasn't the client used the $300,000 in savings? Because, let's say they want to keep that safe, right? That's their emergency fund. Again, they're taking an $800K loan at 5%. So an $800K loan is about $4,295 for a 30-year mortgage at 5%. So let's look at margin borrowing. The client doesn't need to sell investments and pay taxes for the down payment. So that's a huge upside. So instead, the client borrows $1 million at 2.5%. And that's at a 77% loan to value ratio. And that's because the client, the broker includes the value of the savings account in doing the loan to value ratio. So you're going to move the savings account to the broker. The client is left with $1 million investments making 5%. So they're still making 5% on their investment, whereas here you had to sell $285,000 that are making 5%. You still have your $300,000 savings account, but instead of 0%, it's making 1%, right? Because that's the value of keeping it at the broker. There's $1 million loan at 2.5%. There is no mortgage payment, right? You're not required to pay the loan. Obviously, you can, if you want to. If you think about it, an $800,000 loan at 2.5%, it would be $3,161. So if you think about it, if you really wanted to, you could pay $3,161, or you could pay $4,295 back or invest back into your portfolio, right? So instead, you can kind of think about it from an investment standpoint. And instead of paying a mortgage, I'm putting $42.95 into my investments every month. I'm saving, I'm investing that $42.95 instead of paying down a loan, right? Again, another upside of margin borrowing. If you have the capital, might as well continue to invest as opposed to paying down debt, right? So you're continuing to invest here. And again, your asset's making 5%. So, and again, just a quick comparison, an $800,000 loan at 5% is about $42.95, whereas an $800,000 loan at 2.5% would be $31.61. So, again, if there's value in using margin borrowings, because again, instead of paying down your debt, you're investing more. You're just saving and investing for your own benefit. So let's talk about, well, when can I use margin borrowing? What are opportunities for borrowing, using margin borrowing? So the first is buying a home. You get lower borrowing rates from a broker than from a bank. There's no need to sell assets for a down payment and pay taxes, right? In the previous example, you had to sell assets that were making 5%, right? So why would you do that if you don't have to, especially if you can borrow at lower rates? Refinancing liquidity. Let's say you've paid off your home. You're like, oh, let me, borrow against the value of my home to get some cash. Let's say I want to buy a second home, or I want to go on vacation, or whatever it is. It's actually cheaper and more efficient to borrow against your investment portfolio. So if you're looking at liquidity, before you look at taking a second mortgage on your home, you really should look at borrowing against your investment portfolio, because the rates are going to be a lot lower. The last we'll talk about is a cash reserve facility. So let's say you're running a business, you need a safe liquid reserve facility for your business, but you also want to earn a spread on the assets. Again, you're going to buy a 3% asset and you borrow against it at 2%. So we're just going to quickly look at this last example of a business wanting to have a better cash management facility. So again, in this slide, we'll just be talking about how to use margin borrowing for business cash reserve liquidity. We're going to use a hypothetical example. So let's say the client is a business. They keep $2 million as a cash reserve facility to meet liquidity needs. Let's say they have $400,000 worth of expenses every month, and then they refill the cash account every month from profits because the business is profitable. So again, $2 million, they're paying $400 a month in expenses, but then they're profitable, so they put $400,000 back. So they keep a steady $2 million cash reserve. That $2 million is sitting in a savings account making 0%, right? So they want a better cash reserve liquidity facility to eliminate opportunity costs, right? Because they're keeping $2 million in cash making 0% where that could be making money. But they also want it to be liquid because they need to pay $400,000 worth of expenses every month. So what does the client do, or what should they think about doing? First, you need to invest in safe assets that are really easily liquid. So you don't want something, again, that's super volatile, jumping, where the loan to value ratios can be significantly affected. So the client decides to invest in short-term U.S. Treasury notes that mature in 18 months, making 3%. I'm using a ticker example if you want to look this up. So it's a safe short-term U.S. Treasury notes. The client invests $2 million in the short-term Treasury notes, and they borrow the $400,000 of expenses against it every month at 2.5% to pay expenses, right? So by doing this, and using this kind of facility, they're essentially able to make money on the assets while also earning a spread between what they're borrowing from and what the assets are earning. So again, instead of selling assets, they're borrowing against it. And by using this as a cash reserve facility, the business is able to make $22,000 every 5 months through this process. And so it's a more efficient use of using a cash reserve. And in case they needed to sell the whole thing, let's say all of a sudden the client wants to use the entire $2 million facility to buy a new business, right? They want to, use that entire reserve. The great thing about buying safe assets like Treasury notes is that's easily liquid. You can sell that fairly easily without much of a spread on the or loss on the opportunity here. So that kind of summarizes the presentation. If you need help implementing margin borrowing for your own personal investment portfolio or your business portfolio, feel free to contact us at Cove Actuarial Services. My name again is Rajiv Rebello. You can reach us by phone here or directly by email is probably the best way.